Okay, in this video I want to talk to you a little bit about some chart pattern, a real basic common chart pattern that every technician should be aware of, and that's what we call triangles. Okay, so basically triangles pop up all over the place, and in this video I want to go over the variations of triangles. Now again, there are typically 4 or 5 triangles that we always look for, but only one of them is really very common. So one is that you have an ascending triangle. An ascending triangle is where the market has, let's go and take a look at, price starts to move up and then it starts to kind of stabilize. And then basically what it does is it creates this equal highs but rising lows type of pattern. And what we want to look at is that a lot of times they are considered continuation patterns. All right, so in a sense, there are certain occasions when they do turn out to be reversal patterns, but that's not what we're going to talk about here. So again, the triangle in general, let me back up here real quick and talk about the triangle in general. The triangle is how it develops is essentially from the sense that the bulls and the bears are running across a sense of equilibrium. So when we talk about triangles, we talk about equilibrium. And also the fact is that the market is running into a key level of support and resistance where the market just can't determine what it wants to do. So if we're at about some key level of support or resistance, we don't know exactly what the level is. The market will have a tendency to oscillate above and below the level, and it will essentially coil is what the word is. We use the word coil because the market has a tendency to die out or become less volatile or less active. And so what you'll notice is that we oscillate up and around a support and resistance level. We go up above it, we go down below it, we go up above it, down below it, etc. And what happens is that, again, the bulls are getting aggressive because you can see that they're buying at higher lows. In other words, they are less willing for the market to come down to this low. They would like it to come down. They don't mind picking it up a little bit higher, and then subsequently what they do is they buy it even higher at this low, and they support the price. At the same time, what you're going to notice is that the bears are doing the same thing, where they will have a tendency to sell the market at a lower price. So at first they're sellers at this level A, then when we reach another extreme, they'll be willing to sell it at a lower level, and then subsequently again they'll be willing to sell it at a still lower level. Again, the bulls and the bears start to battle it out around this level, and you have to wait for the market to determine who's going to be winner, and that's determined by essentially a breakout of the pattern. Typically what happens is that the market will break out of the pattern, and then and that's how you know what direction to go with it. So again, we have ascending triangles. In ascending triangles, the market is typically moving up, and it reaches a level of resistance where the bears are defending price or defending a level. And what happens is that they are able to push down the market, but what happens is that the bulls are getting aggressive and they are willing to pay up for price. So what you'll notice is that the bulls are paying higher low, making these higher lows, and essentially they are paying for the market at higher levels. Now, typically, what happens is that you can see that the bears are trying to defend the levels, but eventually the bulls are able to overcome the bears, and the market typically goes in that direction. The second one that you have is a descending triangle, and that's usually the opposite. So you're usually moving down to a level of support, and then the market bounces off of this level. The bulls try to defend it, and we come down to the level again, but the bears are able to overcome the bulls. And typically what you notice is that the bears are willing to sell it at lower levels. Okay, so in the ascending, there's an up move into the triangle. In the descending triangle, there's a down move into the triangle, and this has the ability to move prices even lower. This is why they're continuation patterns. The third triangle is what's known as an inverted triangle. And typically how this develops is that you're going to notice that price action is basically creating some sort of a big massive, we'll call it it basically widens, or the volatility expands. And the reason why this happens is because you're moving from a sense of quiet market. Usually you have a sideways consolidation, and then all of a sudden you get really high extremes in these situations. In these particular patterns, I do look for a continuation as well, but these are typically around like news events, or when, like I said, it's typically quiet, and then all of a sudden you get this big erratic type of move. The fourth is a right angle. And in a right angle, you're basically looking for this is basically where you find where price has a tendency to move in a direction along a particular, like if you have typically what happens is that you have this, either this is the price axis, I'm sorry, this is time, right? So this could be like your date in time and stuff like that. You have, let's say January, February, March, April, whatever. And then typically what happens is that price has a tendency to move, up and around this, this type of pattern where eventually you're going to see that the market responds to this angle here. I don't see these very often, so I really don't watch out for them. But the biggest one that I really look for is what we call the symmetrical triangle, and that's what you're looking at up here. Okay, so this is the one that I pretty much watch the most. Watch for, the most is that this symmetry, this symmetrical triangle, where the market has a tendency to come into this very nice consolidating pattern, and then it breaks out in one way or the other. Now, typically what I do look for in this, and the reason I mention these symmetrical triangles is because I look for them as very important trading opportunities, where what you're going to notice is that as the market creates this symmetry, you can either come into it, moving down, and then typically you're going to see a downward move off of that, or the exact opposite, where the market basically moves up into the level, and then we break out. Now, what's important is that you're going to be looking at what's known as the apex. So this level right here is what we call the apex. And what happens is that the market will use this as support or resistance. So you're going to draw a line like so. And then once you break out of the pattern, you're going to be looking for, and if you break down here, you can see how you broke down. You'd be using this as resistance. So you're going to see the market go down and then come back up, boom, use it as resistance and then fall back. If you notice that the triangle breaks up, then you're going to use this level as support. You're going to see it come up and then break back down, boom, use it as support and then rally. So I wanted to show you a quick illustration of this. This right here is just a quick a pattern that we've identified over the past couple days. And you can see how the market basically came into this level, bounced off of these key lows, and then the market rallied pretty substantially off of this level. And then from there, it continued to the upside. So you can see how we entered into the triangle. You know, you have your entry here, right? You have your entry into the triangle, and then you have your exit, and then you have your retest of support. And this is really crucial because it allows you to be able to pay attention, you know, and wait, knowing that you broke out here. I mean, the aggressive trader is waiting for a real retest, a little retest here, and then they can trade it. Or you wait for the market to break down and then come back here and test it again, and providing support that allowed you to take advantage of that. I mean, even if you know, what's interesting is that you're gonna be able to identify triangles all over the place. You can see one here. This is a little bit, you know, weaker, or should we say less as strong. Not as strong as this big one. The bigger the pattern, the more significant is the way I'm looking at. You know, because this is a small one. We did have a level of support. We rallied off of that and then failed over here. But you can see that the market did respond to it, at least momentarily, before breaking down, which is why I like, you know, if you're not able to stay above this level, then that's going to be a pretty decent shorting opportunity. And, you know, potentially looking for the lows here. We'll see what happens, but that's what I got for triangles, and I hope it helps. If you have any questions, don't hesitate to reach out. This is the Witch Doctor signing off. I hope it helps. We'll catch up to you in the next tutorial.